Welcome, everybody, to Zoom at 8. My name is Julie Ann Peterson, and I'm with Old Capital Lending. We are a premier provider of debt in multifamily. I mean, we are specialists. We closed $1.2 billion last year, and 80% of the business right now is being done in bridge. We just got an increase in rates, and it's coming. We got 20 bips 2 weeks ago, and we got 20 bips today. So get ready. Make sure that you're underwriting the right number. So if you are looking at a deal and you want to understand, hey, what does the financing look like on this? Give me a buzz. Let me know what you're working on. Every deal is different. It's not like single family. If you've come from that world, single family is going to compare to everybody on the street in the area. Not so much with multifamily, as you know. It's all about the net operating income and how are we going to raise the rates? How are we going to raise the rents? How are we going to make this and change this deal so it attracts more people? So if you've got that opportunity that you're considering, I can give you a loan quote. I'll need your T12, your rent roll, your OM. If it's on market, that's an offering memorandum. I'm going to need your underwriting. And if we're going to think about putting in a lot of CapEx, I'm going to need to understand what that CapEx looks like. I'm going to need to see what the rent comps look like as well. So you can send those over. We'll have a discussion and let you know exactly how to underwrite this deal. All right, so we do some great things here at Zoom at 8. We meet every Tuesday night. And thank you, everybody, for making a commitment. We've been here for nearly 3 years. We've closed 10 deals. And there are people in the house that have closed those 10 deals with us. So thank you for making Tuesday a great night to visit and learn with investors in multifamily and in other asset classes. So tonight, Nate and his wife Bethany, who are here, are real estate investors and own a growing financial services agency in San Diego. Nate specializes in financing strategies designed for business owners and real estate investors to help them save, grow, and protect their wealth. He also has a background in military, actually in the Air Force, and he serves part-time in the California Air National Guard. So both Bethany and Nate have invested in 3 JV deals. They own 100 units. And, you know, Nate and Bethany use these strategies that we're going to talk about tonight and use them to their money in deals like this and how they can pull out their capital and invest in other deals. So tonight is going to be a great show. And also make sure that if you have questions, let's get them in the chat. You can put a question and we'll get them answered. Nate is, he's really, he understands this. He's passionate about it. And we really want to hear from you tonight. So Nate, welcome to Zoom at 8. How are you?
Awesome. I'm great, Julie. Thank you so much for the opportunity to share with the group. And I'm excited just to dive into this topic. I love it. I absolutely geek out over this stuff. And I'm excited to share with you guys.
You know, most insurance brokers, well, I don't say, you know, JT Lynch, he's all right too. He makes life fun. But most insurance brokers, they're not so fun. So it'll be great to hear your passion coming through on life insurance. Okay. Because, you know, I actually use this vehicle to invest as well. So I'm really fascinated by it and really want to share it. So I'm going to turn it over to you, Nate. You can go ahead and share and let's get started.
All right, awesome. Well, thank you guys so much. Very excited to be with everybody tonight just to share. So we'll start to share a little bit about my background and kind of how I got into the industry. Like she said, I have a background in the military. And as I was leaving active duty, I was looking for a way to make some money. And we were getting into real estate investing and we dove into apartments. We got our first deal in 2019 and we weren't making any cash flow from it though. Because it takes a while to make some money in real estate. So we figured out we got to figure out a way to make some money. We looked around, we noticed that a lot, our mentor in real estate investing, and a lot of the bigger players in the real estate investing space usually own some sort of business that produces cash flow to buy real estate. And so that was one of the reasons why I started our financial services company. Was I was looking for a business that could scale to produce cash flow by real estate. The other thing that really got me passionate about it was I started diving into different strategies on ways to get leverage on my cash, different vehicles to be able to store capital, preserve capital, and ultimately leverage that capital for other opportunities. And I found that there's a lot of options out there. There's your EQRP, solo 401k, self-directed IRAs. And then I found out about this high cash value life insurance strategy. And tonight I'm going to be speaking about that topic. There's multiple vehicles that serve multiple purposes depending on your specific situation and where your capital currently sitting. But if it's liquid sitting in the bank, this can be a potential great option for your clients. And I really truly believe this is something that everybody should be utilizing in some capacity, because there's other benefits that these policies provide you as an investor, as a solo, as an entrepreneur in the real estate space. We're thinking about estate planning, taxes after death. We're thinking about tax advantages as far as tax-free growth and tax-free distribution, that sort of stuff. This is a really important deal. Now, before I get into my presentation, everybody here is real estate investors. Do you understand how real estate works? You understand you buy a property, you fix it up, you build equity, you refinance it, pull the equity out, it's tax-free, do whatever you want with it. If we're smart, we roll that into the next deal. But if you understand how that works, you'll understand how insurance works, because it's the exact same thing. It's just a different asset. Insurance policy, put money into it, it builds equity. That's your cash value plus the growth that it appreciates. So think of appreciation on a real estate deal, except it only takes 5 to 7 days to get access to your cash and your policy, not 2 to 3 months in a refinance. So depending on if you have capital sitting around, you have clients with capital sitting around, they need a place to put it. This could be a great option for them. And so we're going to get into how this works. And I've been told that I make this clearer than anybody else they've talked to, because I've talked to I have one client right now I'm talking to that he's had a guy who's been pitching this one forever. And I spent 20 minutes on the phone with him and he was like, this makes more sense than anything else that they try to explain to me. So I'm excited to dive in and share it with you tonight. So let me pull my screen up and we will dive into exactly how this works. Now, there's a lot of different terminology you'll hear out there when it comes to this strategy. I like to avoid the terminology, but some of the things you'll hear out there, cash flow banking, infinite banking, bank on yourself, all this stuff, those are all just like marketing names for how this works. I'm going to focus on the specific strategy and how you can utilize this. So this is not a new strategy. It's been utilized for generations. The wealthy have used it, banks have used it, large corporations have used it, higher earning executives utilize these strategies for different purposes. But it's a way to grow money tax-free, access money tax-free, no market risk, because your principal is always protected and the gains you put in are protected. And it's been utilized for a long time. So I want to cover, let's see. So again, this is educational purpose only. I like to just throw this quick disclaimer out. Every situation is different. It needs to be customized to you. So if you have questions, we can definitely meet one-on-one afterwards to cover your specific situation. But the key benefits to this is, especially for investors, is capital preservation, capital growth. Because one thing I was not excited about was putting my money at the bank and sitting it there making me 0.0 nothing in the bank and then losing to inflation. It was like 6 or 7% right now. And then also leverage. We had talked about a lot about leverage in real estate investing. And this was one of the vehicles that I found to really provide that leverage. So there's 4 key benefits that this strategy gives you. First one is it's a safe and secure place to park capital. And it provides certain legal protections and creditor protections as well on the cash that is inside of this account. You also maintain liquidity and control of your cash, and typically very high liquidity when it's designed correctly. So, obviously it is attached to an insurance policy, so there's a cost of insurance, but the way we design these is it minimizes that as much as possible based on your specific situation. And you can have up to 90, sometimes more than 90% liquidity on your cash day one. So what I did last year, personal story, we refinanced our first property, pulled a bunch of equity out, and I took that equity, I put it in my policy, and a couple of weeks later, we had another deal we needed to fund. So I borrowed 90% of that money, took it out, put it right into the next deal, and now it's sitting in that deal where I'll probably refinance that in the next few months, and we'll pull close to double what I put into it. So that's how I'm utilizing it as an example. And I'll get into more details of that. You also get tax-free access and distribution. So if you think of like how a Roth IRA works, that's how that's very similar tax benefits as like a Roth type of vehicle. And you get secure compound growth without risk of losing. And Warren Buffett says the number one rule of money is don't lose money. And the second rule of money is don't forget the first rule. And so this is a place that you put your money in, you're not going to lose it because the market takes or something like that. Just something else I'm always find interesting is what does the banks do with my money? Because they'll obviously like to take my money, and the Wall Street likes to take my money. But banks put billions of dollars in cash in life insurance. This is Wells Fargo. This is dollar figures in thousands. So you got to add 3 zeros. That's 19.2 billion. Bank of America has 22.7 billion inside cash value life insurance. So I just share that with you to let you know that, the biggest people making the most money, the banks and Wall Street and all these people, this is a place they put a lot of their money. You can even go to like large corporations and pull up their public data, and you can see where all their executives, where most of their money is going. A lot of it ends up inside life insurance, executive bonus plans, and things like that. Now, what is the benefit of this strategy, say, over your EQRPs, your self-directed IRAs, your solo 401ks, and things like that? Well, one is your money stays in the policy and it keeps working for you, and you can borrow against it, just like you pull equity out of a property tax-free, you can pull equity out of your policy tax-free, and you can leverage that cash to acquire other future opportunities. Probably for everyone else on this call would probably be real estate, but it could be any opportunity in the future that you need access to cash. And they don't have any restrictions on what you use that cash for. It's like your solo 401ks, your self-directed IRAs, there's a list of things that you can use, which includes real estate. So, for most of us, that's not a big deal. But if somebody wanted to use it for something else, there's no restrictions on how you access the cash and what you use it for. So that's a powerful, as far as options, it's giving people more options with their capital. Basically what it is, it's a max funded cash value life insurance contract. There's a lot of flexibility in this. This doesn't mean it has to be max funded every single year. One of the key benefits of this too, over like an IRA or a 401k type plan, is those have annual limits. And you can't make up for previous years if you didn't max fund up to those limits. But in a policy, for example, just to keep math simple, let's say you were doing $100,000 a year with the bucket we built. One year you do 100,000, next year you do 50,000. The third year I can dump in 150,000. So if I'm a multifamily investor, I'm gonna tie my money up for the next 5 years or something like that, or 7 years in maybe a syndication. I need time to roll that money. I may max fund at the beginning, borrow it, put in my deal, and I kind of mid fund it for that 5-year window, maybe my cash flow or something like that. And then I make a big profit on the sale or the refinance. Well, now I have a place to put most, if not all, of that capital, depending on how much room is still in there. So that's a pretty cool thing too, is you can catch up from previous years. You don't have that restriction that you would have in more your IRA 401k type of situation. So basically how this works, this is the most simple way I can explain this, is you have capital, you guys got to put it somewhere. So you just stick it into your policy, call it a bank, because essentially we're doing banking type strategy. And when it comes to leveraging your cash and you need to utilize it, you don't actually borrow your money. You actually don't take your money out of the policy. Your money is the collateral for the loan. And so you go to the insurance general fund, they give you a loan on your cash value, and then you buy an asset with it. And then while that loan is outstanding, they essentially have a lien on your cash value, and they don't care when you pay it back. There's no payback requirements. You don't have you have to pay it back in 5 years or 10 years. You could never pay it back if you wanted to, although that would kind of defeat the purpose of the strategy, but you don't have to, because they know one thing's guaranteed in life. We're all going to die someday. So if we pass away and there's a loan outstanding, they keep it, and the difference, whatever's left over of the policy, so you have the death benefit plus the cash value, that's going to go to your beneficiary tax-free whenever you pass away. So and then
I want to unpack that for just a minute.
Okay.
So here's a real life, my story is that we needed to take out money to do some renovations on our house.
Mm-hmm.
We took a loan against my husband and my life insurance policy. Mm-hmm. That was probably 10 years ago. Mm-hmm. It is still paying me every month the interest rate that we took it out at, and I can choose to put that money back in, or it can go to for the life of my through my life, and it will take out the money that I paid, that was paid to me, and I never have to pay it back. I think that is so everybody understands this. It's a loan. You can choose to pay it back. You don't have to. You have access to this cash.
And I'll cover the specific how the loan function works, because it's nothing like traditional financing, like you would go to the bank. It's just the reason it's a loan, just like you're refinancing, you pull equity out of a property, that's a loan. That's what allows it to be tax-free. But some of these loans can be as low as 0%, depending on how it's set up. But anyway, so now you pay that money back, your asset, you refinanced it, cash flow, whatever the situation is. Now there's no more loans, so there's no more, your cash flow is not collateralized, so there's no lien. Now you have an asset that can help, to potentially fund this. And also too, you can have multiple of these policies too. You're not limited to like one. I know I personally have two. So people have multiple policies, and you can open up different accounts. So if you have a bucket we create and you max that out, you're like, oh, I can put more in. You can add additional policies to make bigger buckets. All right, so I want to cover the key benefits of this, because there's more. Because obviously we're focusing on the cash value side of the insurance side, but there's some other really important benefits as investors. And when we're thinking about like estate planning, wealth preservation, even generational wealth. One of my clients, we were setting him up an account, and he was telling me that he owns a bunch of real estate, but his wife has zero interest in real estate. And he was joking that if he were to pass away, his wife would have for sale signs in front of all his properties before he was in the ground. And so, anyways, but I was saying, but this gives her options now. If we don't expect that to happen, we don't want it to happen, but let's just, consider possibility. If that were to happen, she's going to have access to potentially, well, in that case, millions of dollars in tax-free lump sum cash that now she's not forced to go fire sale everything. She can take a time to figure things out, get some quality, counsel on what to do, and then liquidate everything. So it just gives people more options, and gives our people we leave behind more options when that time comes. Hopefully it's after a long, successful life and we're not died early, but eventually it's going to happen. So we want to make sure we're protecting our families. So permanent life insurance. Also, certain policies, and most of the policies I work with my clients have, include living benefits. So what are living benefits? This gives you the potential to access up to potentially hundreds of thousands of dollars of the death benefit of your policy in the event that you were to get a chronic illness, critical illness, or terminal illness. Why is this important? Well, if we're investors, a lot of our capital gets tied up in deals. Maybe we have money in a 401k or IRA if we have previous W-2 employment. And typically what happens, health insurance is limited. So they'll cover a certain amount, but eventually you're gonna have, if somewhere to happen, you need access to capital to pay for it. What ends up for a lot of folks, without having this protection in place, you end up having to tap into your retirement investments and all these other resources. And before you know, if you run out of money, it's the number one cause of bankruptcy in America today. So having the living benefits is no additional cost to have that benefit, to potentially, if something were to happen, you have access to cash relatively quickly compared to if you had to go refinance a property, pull equity out, that could take a while. This can give you access to cash faster in the event that something were to happen. If you don't need it, no big deal. There was no additional cost, but if you need it, it's there. You get tax-free distribution and inheritance. So distribution for the things we've been describing. And then if you think of generational wealth, this is guaranteed tax-free money to your beneficiary, which a beneficiary could be a person, a trust, charity, it could be really almost anything. You have legal protections. So not only on the, it's because it is considered life insurance, there's certain protection that life insurance has, which gives you protection on the cash from like creditors and lawsuits in certain cases. No age distribution restrictions. So there's no waiting to 59 and a half and, otherwise you pay 10% penalty like that. That doesn't exist here. 0% floor security. That's the guarantee that your principal is protected and any gains that are locked in on your base are protected as well. And basically you get secure compound interest because and with no risk of losses, and no risk of losses is a pretty important thing to consider when you're setting up, as far as growing your money to zero market risk, there's two different types of policies that you can utilize these strategies for, but essentially, depending on how the money is growing, you have a 0% floor, which is guaranteed. So in this case, this would be an index-linked account where your money is growing against, but you don't have any risk to your capital or any gains. So your 0% floor, you can earn up to a ceiling or a cap. The floor is guaranteed, and the caps range anywhere from 8 to 20% with some uncapped options too. Most of my clients don't play the uncapped range because it's just, there's more risk involved with that, and people will make way more money in real estate anyway, so it's not worth it. But you do have, this is basically the structure of how the cash grows. You have the floor guaranteed, so if anything loses, you don't lose, and then the growth, the money can grow up to a cap, and you don't. So you're, I would say on average, these do about 5, 6, 7%, maybe 8% per year, with opportunities to get the double digits as well. This is a way to, this slide here illustrates the link to index for the growth. This top blue line is an example of an indexed account with a 0% floor and a 12% cap. And this is an example of the S&P. Now we're assuming we're not dollar cost averaging. We're not buying at the bottom like you should. We're just assuming we start with $100,000 in 2000 in this particular charts example, and this runs to 2019. If you had money inside of what's called an IUL, index linked account, this would grow like this, and you would never lose. You'd only gain with the market. And then in the IUL, you have losses. So the actual return on the S&P from 2000 to 2019, assuming again you weren't dollar cost averaging and doing all that sort of stuff, was only 4% versus having a floor and a cap protecting against losses, and it came up to 6.48%. And so, one of the things that really got me passionate about these types of strategies and making sure people at least know they're available is I watched my in-laws take a 40% in 08. And it wasn't the 40% hit that was so bad. It was the 8 years it took them to get back to break even. They weren't, they're not in the real estate and stuff like that, but it's still, I just saw the impact of those losses, and it forced them to retire instead of 65, they retired at 70. And they lost 5 years, 5 of the golden years for them. So how does cash value life insurance work? So basically there's 2 buckets. You have a death benefit side, which we minimize and we shrink wrap as much as possible based on the size of the cash value bucket that we create, which is customized to you individually. But on this death benefit side, you have some key benefits. You can add long-term care options, which is something to really consider because it's not cheap. And then you have chronic and critical illness protection, which is built in. And the cash value gives you all these benefits. So you pay a premium, small portion goes to cover the death benefit, and the rest goes to cover your cash value. And that's essentially how it works. Now, another aspect that's really important to understand about cash value life insurance, depending on the type you're using, I'm specifically going to describe a index-linked insurance policy, is how the death benefit and the cash value correlate to each other. And this is a very important thing to understand. Otherwise, if it's not set up correctly, it can hurt you long term. But if it's set up correctly, you won't have an issue. It's just working with somebody who knows what they're doing. So basically, you put money in, that's call it your premium. There's a little bit that goes out for the expenses of the policy, and then your cash value grows. When you first open your policy, you have a certain amount of insurance that you're paying for. But as this cash value grows, it's essentially buying up your insurance. And so as you get into later in life, this red line gets a lot smaller to where, down the road, it's shrinking over time. You still have the full death benefit you paid for. It's just what your cost of insurance is based on, and what your cost, all that is based on. It's based on this red line. That's called net amount of risk. But that's very important when it comes to your policy design, that over time, you want this to decrease. So that way when you're older, you're not still paying for a large amount of life insurance. So I'm going to cover briefly the IRS codes of how this works. I'm not going to get deep into the weeds on this, but I just want to give you the highlights of why we can do this. And also something really interesting that happened this year. The IRS changed something with these insurance policies, and they actually increased the amount of money you could put inside a policy without increasing the amount of death benefit required to put that money in. So for example, when I opened on a policy last year, I had a limit of $25,000 on the particular policy that I designed for myself. And then this year, if I had opened that same policy this year, I was able to put in $50,000. Fortunately, that policy wasn't grandfathered in, so I opened a new one because I like the bigger bucket, but my goal at the end of the day is I want the smallest death benefit possible when I'm designing it for the strategies that we're describing. So I thought that interesting that the IRS changed those rules. Who controls the IRS? Who changed the codes? Probably people that are looking for ways to store money and not have to pay taxes in the future. So here's a basic code. 72E allows the money to grow tax deferred. Now I know I've been saying tax free all day long. So just like in real estate, if you own the property, you pull the equity out, you don't pay taxes. But if you sell the property and you don't 1031, there's going to be a taxable event. As long as the policy is enforced and you don't sell it, i.e. liquidate it and surrender it, you never pay taxes. So the tax benefit is because of the tax shelter of the policy. 7702 allows you to access the money tax-free. Same rule that allows you to access tax-free money in the real estate deal. 108 allows you to transfer tax-free when it's all said and done. Another really important one is called the TEFRA corridor. This basically just dictates the minimum death benefit required based on how much money you wish to fund a policy. We have software that figures this out because it's dictated based on how much money you're putting in and what age you are. The younger you are, the more death benefit you need. The younger you are, the less death benefit you need based on the money you're putting in. And there's this thing called TAMRA. Basically, this came out in the 80s because what was happening is people were putting a lot of money into insurance with very little death benefit. So it's kind of defeating the purpose of the life insurance side of it. And so basically, the IRS came out and said, hey, you need to be able to fund this for at least a minimum period of time to maintain the integrity of the insurance side of it. So the minimum is 5 to 7 years to do that. All right, so let's talk about the most important part of this strategy, and that's how you access the money, because that's what we're trying to do, right? So there's basically 3 ways that you can access the cash. There's 2 main ways. And the first way is withdrawal. You can withdraw all your contributions without paying tax. All the money that goes in this is post-tax. If the money is taxable, it's after-tax money, just like a Roth. If you withdraw more than that, when you're actually taking your money out of the policy, you pay taxes on it. But that's why we don't use the withdrawal feature very often. The only time withdrawal really happens is if somebody's taking income in for retirement and they're not intending to put any money back. Borrowing is the name of the game. So again, it's not like borrowing from your bank. There's especially 3 ways you can do it, called participation loans, non-participation loans, and another one called synthetic loans. I'm going to explain each one and how they work. So the first one we're talking about is a participation loan. I call it an index loan if it's an IUL, it's a participation loan if it's whole life. And basically how it works is, let's say you have $1 million in cash value and you need to borrow $500,000. So you borrow $500,000, they're going to charge you an interest rate. And let's say, and my current policy I have is an interest rate of 4.4%. And so if I had this situation looking like this, I'd be paying 4.4, but I would still be earning a return on the full million, even though I've borrowed against 500,000. Now, if I'm earning a decent return, better than 4.4%, that's a positive deal. I'm earning a little bit of a spread, a little bit of arbitrage in there. In this example, would be 2.6%. That's not too bad. So if you don't want to worry about that and play that game, because this growth rate isn't always guaranteed, it could be less, could be more. You can use, there's a second type of loan that's available, and that's a fixed loan, or what's called a non-participation loan. Typically, this may have a small spread, or it could be 0%. So basically how this one works is, let's say you have $1 million in cash value, and you want to borrow $500,000 again. What's going to happen is they're going to move $500,000 out of your growth account that's earning a rate of return, in this case I call it an index account, into a fixed account. In that fixed account, they're going to charge you an interest rate, and they're going to guarantee you a rate of return. And so usually in the first 6 years, there's a small spread. Like the example I have here, they're charging 2.25%, and they're guaranteeing a return of 2%. So your net cost is 1/4 of 1%. And then you're earning whatever return is produced on the other $500,000 that's you didn't borrow against. Usually after year 6, in most policy cases, the fixed loan becomes a wash, and what they credit you equals what they charge you. Now, with the index type of policies called IULs, you get both of these loan options. If it's a whole life policy, it's either a company's a non-participation company or they're a participation company. It just depends on which company we're looking at. And I work with both types. All right, and then the third option, this one isn't as common, but if you needed to, you could go to the bank and say, hey, I have cash value life insurance. In fact, if you've ever noticed this, when you're filling out a loan application, one of the questions on it, when they ask you about your assets and all that sort of stuff, is how much cash value do you have inside life insurance? Because that's one of the things that they look at. So let's say you have $1 million in cash value again, and you go to the bank and say, hey, Mr. Banker, I have $1 million inside my life insurance policy, and I'm looking to get a $500,000 loan. And they say, great, we can do 4%. And maybe your policy loan on the index loan, that's a variable. So currently it's 4.4%. It could go as high as 7.5. So if that's gone up, and I don't want to, but the bank can offer me 4% versus 5 or 6%, this may be worth it. However, I got to go through all the hoops and hassles of traditional financing with the bank. So you do have the hoops to go through. But if you're still earning a decent return, if you're earning a good return on your index strategy, or the growth strategy, I should say, you could still get growth. You're still earning a spread there. And then if you need to pay the bank loan back relatively quickly, you can access the cash inside your policy within 5 to 7 business days and pay that bank back. So that's basically how that works. So there are a couple catches. There are a couple things we have to know about these policies, and nothing is free, right? So a couple things to know about these policies. One, there's a surrender charge, and that's for the first 10, usually the first 10 years, depending on the company. And that surrender charge decreases as time goes on. So you have a surrender charge potential. There is a cost of insurance, which we minimize. Must be designed right. This is so important. I've seen a lot of policies that were not designed right, and it wasn't bad, but it wasn't as good as it could be. Cap rates can change, but they don't arbitrarily change. They're usually linked to market volatility and interest rates and things like that. But they're usually pretty consistent. A couple other things to know when you're looking at these types of strategies, regardless of the type of policy you're utilizing, is it's important you use a mutual company. Mutual companies are client first and profit second, because they don't have stockholders that they're trying to make sure that they're taken care of. So mutual company advantage is definitely important. Also, insurance companies are different than the banks. They actually have to have solvency. Unlike the bank, who takes your money and they immediately loan, I think they've been able to loan 100% of out through COVID. Usually it's like 90%. So for example, you have a bunch of cash in the bank, you want to go pull cash out today, good luck with that. But insurance companies have to stay solvent. And then they're backed also by the national and state life and health guarantee associations. So if an insurance company were to become insolvent, they are backed by these associations. However, I work with a very large platform. I have access to about 100 different companies, although when it comes to this strategy, there's a handful that work really well for these. But typically, again, you want to work with companies that have long track records, have high ratings, and most companies I work with have been around for over 100 years. So that is a very high level overview. I'm going to show you a small portion of an illustration just so you can see what I mean by liquidity and what a good design can look like, depending on the type of policy you have. But I did drop my information in the chat, so you can book a call with me, you can connect me on LinkedIn, that sort of thing, if you're interested in doing that. So let me share. I'm going to share one more thing, and then
I
I'll
have
open
one
up for
question
questions.
for you.
Yes.
Kyle had a question. Isn't the loan simple interest? Question mark?
Yes, it is simple interest. Good question.
Okay.
All right. And so let's look at an illustration. So this is just an illustration with one of the companies I work with. And this is just an example of liquidity. Again, everybody's situation is different, but in this particular setup, a client was looking at $100,000 in premium put in. They have 95,000 of that is in the cash account, and 91,000 is liquid and available to access. So if he drops 100K in, the next day he could put a request for that 91,000, have it in his bank account within 5 to 7 days to deploy into whatever future opportunities that they're looking to do. Typical break even, meaning you have most of your cash value equals the total premiums put in. Because remember, we're paying for, there is an insurance benefit that we're paying for, so that's a factor. But usually around 6, and this is assuming a 5% return, pretty conservative. Usually around year 6 is when you see a break even, assuming your max funding. Now, if you're doing a situation like I described before, where maybe you drop 100K in, you borrow 91,000, you put in the deal, and maybe that's taken a couple of years to go through. So you're maybe putting in like maybe 25,000 a year or 50,000 or as much less than what the max amount is. Obviously, that's going to extend out that process. You have less money growing for you, but it's not a big deal because you're making a lot more than 5% on that real estate deal you're probably deploying, or other opportunity you're probably deploying that cash to. So it's important when you're looking at overall return with leverage, is looking at both internal and external returns, and when you're figuring out what you're actually the leverage you're getting on your cash by doing that. So this is just an example here. One other factor I'll point out, and I was talking about that corridor of cash value to life insurance and how we want to make sure that that corridor shrinks between the two. So if you look at here, you kind of see the death benefits increasing as we're funding. But once you stop funding, it goes level. So you notice it pretty much stays the same all the way through. But you notice the cash value is accumulating as we go along. So if we look down at, say, 30 years in, you got about, assuming a 5% return, almost $2 million in cash value, but your death benefit's 2.7. So all you're paying for now is not $2 million of death benefit. You're paying for $700,000 of death benefit. But if you were to pass away at 63, $2.79 million is going to go to your beneficiary completely tax-free. And that includes this number. So that's how that works. So you can kind of visually see how this number stays similar, and then eventually it's going to hit the corridor, and then this will start increasing automatically, but at a much lower rate than it was up here, because here it's increasing by $100,000 every single year. Here it's going to slow down a lot down the road. So, anyways, that is an example of what a policy like that can look like, and if it's designed correctly, what you can do with it. I'm able to hang out for about 15 more minutes if there's any questions before I have to jump off. But any
Awesome.
questions, comments?
There is a question Melissa had. Is this policy needing perfect health? Because we're not all in perfect health.
Sure.
Like
no,
a typical life insurance policy. What do you
yes.
What do you have to go through?
That is a factor. As another factor, there is a health qualification requirement. It does not need to be perfect health by any means. I've gotten clients approved with pre-existing conditions. There's going to be an increase in cost with that, so we've got to balance that with that factor. But it is all your standard health processing. If you're in good health, there's a lot. Some of the companies offer up to $10 million of coverage with no medical underwriting. You just do a questionnaire. But if you do have a health situation, I'll just expect to do a standard health check. They'll send someone to you, height, weight, blood pressure, blood test, urine test, and they go through underwriting, that sort of thing. So that is one factor. Is not everybody can qualify for this strategy, so that is one thing to consider. And that's why we have other vehicles. You have your EQRPs, your solo 401ks, your self-directed IRAs. There's different vehicles for different situations. And if you can qualify, I definitely think this is something that should be a part of your overall strategy because of the risk benefits you're protecting yourself against while you're building up the other things. Other reasons you could utilize this too as an investor, think of like buy-sell agreements or business succession plan. If you're creating a business to buy real estate and you have two partners or multiple partners, what happens if one of the partners passes away or something happens and they need to be bought out? Well, maybe the family doesn't have the cash to buy them out. This can be a way to buy them out. So there's other ways we can utilize that insurance policy depending on the situation and the client situation. So what period appearance are you seeing routinely of understanding? I have clients that do, I have a $25,000 client, I have a $36,000 a year client. My biggest client does $100,000. And the biggest client I've ever known of is Jim Harbaugh, head coach of Michigan. Part of his contract was they were putting in $2 million a year into a policy. So as long as you have the insurable need big enough to create a big enough policy, you can put a lot of money into these things. There's no restriction. Really, the only restriction is justifying the insurable need, which, creating a $100,000 bucket is pretty much easy for anybody. It's about a $2 million policy, depending on your age. But also, too, there's a lot of flexibility into it. So just to give an illustration on flexibility, when I set my policy up initially, I paid very minimal premiums. I paid like $200 a month because I knew I was going to refinance a property and I was going to get my lump sum to put in the rest of it. So I can set up, there's a lot of flexibility. You're not like, if it's designed to do 100,000, that you have to start with that right away. There's a lot of flexibility that can be built into this. And then after you give it a couple of years of funding, you have a lot of flexibility because let's just say you had a period of time where you couldn't put money into it. Well, that cash value can help cover your insurance cost during that time frame, which is why, like on the illustration it showed you, that was a 10-pay plan, which honestly they could do it as little as 7 if it's maxed every single year and never need to worry about putting cash into it again. Even if I brought that down to even like a 4% return on average, it would still go for the life of the policy. So a lot of flexibility in there based on the client situation, which I think is important as a multifamily investor in particular, where we would be locking capital up for more than just like 6 months, like you would in a flip or something like that. You're locking up for multiple years. It can be it's another vehicle to put that capital. So if you have liquid capital or you have clients with liquid capital just sitting in the bank and they need somewhere to park it where they can earn better, 5-6% return on average, opportunities to capture double digits and still maintain liquidity and control their cash, this could be a great option provided they can qualify.
Well, I mean, spectacular presentation, I have to say, and so helpful to so many people. How do we get at our cash? It's a problem when we've got all of our money sitting in multifamily or other asset classes. This really gives you that, as you keep saying, the flexibility. So I love that. And when you're sitting down with a client and they say, I don't have any money, ask the question, do you have any life insurance? Is there any way that we can help you find a way to get access to that? And Nate is such a great vehicle or for a person to talk to you about that. So if are there any further questions before we let them go? Anybody? Candace, you're always asking questions. Not to put you on the spot, but do you have any today?
Do you find to your question about MEC changes? Yes, it's even better because you can put more money in and not have less without increasing the amount of insurance you need. So basically think about like an envelope. The IRS says this is the envelope you need, and this is how much money you can put in the envelope. Well, they didn't increase the size of the envelope; they increased the amount of money you could stuff into it, which is awesome.
Wait, hold on. What did you just answer? That was the strategy with the MEC?
Yes.
Okay.
Yeah, MEC limits. So basically what a MEC means is if too much money is put into it and it crosses the line of MEC, it basically becomes like a tax deferred account, like a 401k, as far as how it's taxed. Now, that's a conscious decision on your part. Even in insurance companies will, like, if you put too much money into it, they're going to come back and say, hey, you sure? We'll send this back to you because if you MEC it, you can't reverse it. But that's not going to happen. Like, you're not going to accidentally MEC a policy. These insurance companies are paying very close to that because they don't want you, if you don't want it to happen, they don't want you to have it happen. So.
All right. Remember, everybody, when you register for Zoom at 8, you get an email on Fridays. So make sure if you look in your spam, allow those to come, and you'll get a YouTube. We also have it on YouTube on the Julianne Peterson YouTube channel. You can find previous Zoom at 8 presenters on that, but every Friday you'll get a copy of it, as well as you'll see it on our social media. So, hey, Nate, wonderful presentation. I really appreciate your vibrancy and your enthusiasm. It's awesome. You come highly regarded in this community, and really want to thank you for your time.